Imagine being on your lunch break and getting coffee at a cafe in Seoul, South Korea. And all you can overhear from the people next to you is talk about the Korean stock market. More specifically, how much money people made or lost buying and selling shares in two Korean companies, Samsung Electronics and SK Hynix. If you're Korean, these are not some random meme stock companies. Samsung is the biggest and most recognizable corporate names in South Korea, while SK Hynix has become one of the hottest corporate names in the country over the past few years. In fact, there's now a widely circulating joke in South Korea that the best thing you can wear to a blind date is an SK Hynix company jacket, because the moment people see where you work, they know you've made it, thanks to the high pay and social status associated with working there. Little wonder, because SK Hynix makes the advanced memory chips that the entire global AI boom depends on. At the height of the rally, each company was valued at more than $1 trillion US, and together they accounted for more than half of the total market value of South Korea's main stock index, the Kospi. So you just can't escape hearing about these companies, and all your friends and coworkers keep asking whether you're going to invest in them. You think to yourself, hey, these companies are the real deal. Their revenues and profits are solid, their future looks promising in the age of AI, and their stock prices keep rising. Everyone else around me looks like they're making money except me. So why not? Eventually, you invest some of your hard-earned savings. Maybe you even borrow money to invest more because you're afraid this could be your last chance to get in before prices rise even further. And for a while, it works. You see some crazy gains on your investment and you're over the moon. And then, almost overnight, the market begins crashing. Samsung Electronics and SK Hynix start falling. The entire Kospi gets dragged down with them, and suddenly much of the Korean and international media is declaring that South Korea's AI bubble has popped. You're what Koreans call an ant, an ordinary individual investor, also known as a retail investor. As of the end of 2025, South Korea had a record 14.56 million individual shareholders, equivalent to over a quarter of the country's entire population. Much of the most viral global coverage places these Korean ants at the center of the story. The mainstream Western narrative appears to be that Korean ants became too greedy, borrowed too much money to basically gamble, and helped turn the Korean stock market into a casino. And somehow, this Korean situation is now supposed to serve as a warning or even as a preview for other major markets like the United States, which should brace for what might happen if its own AI bubble finally bursts. But if you're one of those Korean ants, this might be extremely confusing. You'd be like, wait, I thought I was investing in companies with solid business models, cutting-edge technology, and real earnings. So how could their stock prices collapse so quickly? And on top of losing my money, I'm also being blamed as one of the main reasons that caused the entire bubble, and now it's also my fault that the bubble popped? What the hell? At first glance, the popular explanation seems to make sense. Fear of missing out, margin loans, and leveraged fund led South Korea's more than 14 million ants to pour enormous amounts of money into two companies that had come to dominate the national stock market. But that's only the most visible part of the story. Could there be much bigger forces at play here? Here at Asian Boss, we always say that you need to go beyond the headlines and look at the context and nuances. And never has that been more true than in this case. Because the deeper we looked into it, the clearer it became that this was not simply a story about crazy margin trading causing Korea's AI stock market to crash. Don't get me wrong, that certainly played a role, but the full reality is far more complicated, and the actual sequence of events may be very different from what the Western headlines suggest. At the very least, we shouldn't draw the wrong lesson from what may be a uniquely Korean situation, right? So let me share our research and present the full picture of what really happened. Then you can come to your own conclusion on whether the Korean stock market really serves as a warning to the US or not. Before we dive in, this whole Korean stock market situation is exactly the kind of topic where local context gets lost. Most of what reaches Western audiences comes secondhand, and the Korean press covering this story will never make it into your feed. Even they have their own political biases built in. That's why we partnered with Ground News, which solves a problem I've been personally wanting to address for years. Ground News gives us transparency when we are sifting through data, articles, and reports on each topic we cover on our channel. It basically lets you access sources from around the world that your algorithm probably isn't surfacing. And I think that's more important than ever, especially if you're trying to understand complex issues beyond just surface level headlines. For example, search Asian shares on Ground News, and you'll see extensive coverage of the latest fallout from the AI bubble popping in South Korea. You get multiple headlines, a summary, and a breakdown of the sources. The topic of AI is also becoming increasingly politicized, so you can see factuality ratings and ownership details for each source to better understand how reliable the coverage is. There's also the blind spot feed, which shows stories ignored by either side of the political spectrum. That level of transparency is incredibly helpful because it shows you how the narrative is being shaped. This is honestly the kind of tool I wished more people used before forming opinions. So if you're someone who wants to stay informed without being manipulated by algorithms and subconscious political biases, subscribe to Ground News and get 40% of the Vantage plan by scanning the QR code, going to ground.news/boss, or clicking the link in the description below. Again, it's ground.news/boss. Let's get back to the deep dive. So why is everybody outside South Korea all of a sudden paying so much attention to the Korean stock market? My guess is that it's probably because from April 2025 to June 2026, the Korean market suddenly became the world's best performing major stock market. The basic argument is that South Korea, or more specifically a handful of AI-related South Korean companies, benefited enormously from the AI boom, and when the Korean market suddenly crashed, that was the bubble finally popping. But if you've been watching our videos, you know we're not gonna just let things slide without questioning the underlying assumptions that everybody else seems to take for granted. For example, was this a classic AI bubble that finally popped? Or was something else going on underneath? To answer that, we first need to take a look at the broader local context in which the Korean stock market and the KOSPI actually operated. So let's dig into that. KOSPI stands for the Korea Composite Stock Price Index. Basically South Korea's benchmark stock market index, roughly comparable to the S&P 500 in the US. But unlike the S&P 500, which selects 500 leading American companies, the KOSPI broadly includes nearly every ordinary share listed on South Korea's main stock market board. And because the main board is where Korea's largest and most established companies are generally listed, the KOSPI includes major conglomerates, manufacturers, exporters, banks, automakers, shipbuilders, you name it. The KOSPI is weighted by market capitalization, meaning the more valuable a company becomes, the more influence its stock price has over the entire index. For example, at the height of the rally during June 2026, Samsung Electronics and SK Hynix together accounted for an average 55.68% of the KOSPI's total market capitalization, which is crazy. At the end of 2024, before the rally really took off, they accounted for 22.63%, which is still huge. Basically, their combined weight in the Korean stock market more than doubled in roughly a year and a half. Both Samsung Electronics and SK Hynix makes advanced memory chips that are essential for AI and tech companies like Nvidia, Microsoft, and Google. So while they're not pure AI companies, they have become two of the biggest beneficiaries of the global AI boom. We might do separate deep dives on these two companies in the future because they both have super interesting backgrounds. But the point here is that even though the KOSPI contains hundreds of companies that have really nothing to do with AI, it increasingly moved as though the entire Korean stock market were one enormous bet on AI. There were days when the KOSPI rose sharply even though the overwhelming majority of companies inside it actually fell. For example, on the day SK Hynix crossed $1 trillion in market value, 826 of the KOSPI's 920 companies went down. That's 90% of the market falling on a day the index hit a record. So it'd be misleading to assume that the Korean stock market experienced a broad-based AI boom. That's the first thing. The second point is that even if Samsung and SK Hynix disproportionately drove the Kospi, that still doesn't tell us whether their stocks had actually become a bubble. So what exactly do we mean by a bubble? Doesn't it mean that share prices have risen so much that they have become totally detached from what the underlying businesses could realistically justify? So had Samsung and SK Hynix really become wildly overvalued before the crash? Well, let's see, because even to answer that, we first need to understand something super basic. What exactly is the relationship between a public company and its stock price? Actually, let's start here. When private companies reach a certain size and need to raise more money to scale their business, they may decide to go public through what's called an initial public offering or IPO. During an IPO, the company can create and sell new shares to the public, and the money raised from those shares flows into the company directly. And by the public, I don't just mean ordinary mom and pop retail investors. It also includes pension funds, mutual funds, hedge funds, insurance companies, and other major institutional investors. Here's the critical part. Once the IPO is over and those shares begin trading on the stock market, most of the money being exchanged no longer goes to the company. If I buy one Samsung share from you, my money goes to you, not to Samsung. That means the company's actual business performance and its day-to-day stock price can operate on two separate tracks. The company could be busy developing and selling products, earning revenue, making investments, and trying to grow. Meanwhile, its stock price reflects what millions of investors are currently willing to pay based on what they believe the company will be worth in the future. In other words, the stock price reflects investors' optimism or pessimism about what comes next for that company. That's why a stock price can collapse even when the actual business is still doing great. By the way, this is exactly what happened to Amazon after the dot-com bubble burst. Its share price fell by more than 90% from its peak, eventually dropping to around $6. This was basically the market saying, yeah, we've completely lost confidence in Amazon's future. But from founder Jeff Bezos' perspective, the company's sales were growing like crazy. Its customer base was expanding, and its losses were gradually improving. So what you need to understand is that while the company and its stock are connected, they're not the same thing, and especially in the short term, can move in completely opposite directions. Now, why is this important to clarify? Because before we can determine whether Samsung and SK Hynix stocks really became a bubble, we first need to understand where they were starting from. And this is one of the most important pieces of context that often gets overlooked in most Western coverage. Long before the AI boom, which we already established was not broad-based in Korea, the country's stock market had a reputation for being chronically undervalued. And to a large extent, that is still true today. Many Korean companies continue to trade at much lower valuations than comparable companies overseas. Even highly profitable and globally competitive companies like Samsung are no exception. At the end of 2024, before the Korean rally really took off, Samsung Electronics generated around 301 trillion won, or roughly $221 billion in annual revenue. Yet, its market capitalization was only about $243 billion. Apple, by comparison, generated around $391 billion in annual revenue, less than twice Samsung's, but had a market cap of approximately $3.77 trillion, more than 15 times larger than Samsung's. I mean, sure, you could argue that Apple had higher profit margins, a massive services business, and other advantages that investors were willing to pay a premium for. But 15 times more valuable than Samsung? Really? Either Apple was overvalued or Samsung was severely undervalued, at least until the rally after 2024. So there has to be a reason for that, a deeper, more structural reason for such an enormous gap. Anyway, this phenomenon became so widely recognized among investors, analysts, and policymakers that it was even given a name, the Korea discount. Think about it. Why would investors refuse to pay more for Samsung shares compared with Apple shares? Because being a shareholder does not just mean asking whether the company is profitable. You also have to ask whether those profits will actually benefit you as an ordinary shareholder. And for decades, many investors looked at the way some of Korea's biggest companies were controlled by powerful family-run conglomerate groups known as chaebol. And this was not just a problem involving a handful of famous families like Samsung or Hyundai. According to an analysis by The Economist, 73% of the large listed Korean companies it examined were classified as family businesses, compared with just 6% in the United States. This should give you some idea of just how dominant family control has been at the very top of corporate Korea. So if you're a minority shareholder, you had limited influence. Dividends and share buybacks were often relatively weak, and investors worried that major corporate decisions could be designed to protect family control or manage succession rather than maximize the value of everyone's shares. You see the problem? This has long been one of South Korea's most distinctive corporate governance problems. Under the legal and corporate governance system that existed for decades, investors did not fully trust that ordinary shareholders would receive the full benefit of those successful companies. But corporate governance was not the only structural problem. Despite having one of the world's largest economies and companies like Samsung, South Korea was classified as an emerging market by MSCI, which stands for Morgan Stanley Capital International. MSCI is one of the world's most influential index providers, creating benchmarks that global investment funds use to decide which markets they can invest in and how much money to allocate to each one. MSCI does not control the Kospi. Instead, it creates its own Korea index and places Korean companies inside its broader emerging markets index. This matters because many global funds operate under strict mandates and may simply not be allowed to invest in Samsung if their mandate only covers developed markets. So why does MSCI still classify South Korea as an emerging market rather than a developed market like Japan? Because its financial market remains harder for international investors to access. MSCI has repeatedly pointed out problems like the limited ability to exchange the Korean won outside Korea, insufficient offshore currency liquidity, and other operational restrictions facing foreign investors. So all of this meant that Korean stocks were not only being discounted by investors, in some cases, potential institutional buyers were structurally kept out. Keep this point in mind because once Korean stocks exploded in value, those same fund mandates and portfolio limits would become crucial to understanding why global investors later started selling. The point here is that because of all these structural factors, many companies listed on the Kospi were trading at a heavy Korea discount. But let's fast forward a bit to the height of the rally because here is where it gets interesting. By May 2026, the market capitalization of Samsung's common stock had crossed $1 trillion for the first time. And by June, it had reached around $1.35 trillion at its peak. There was more than 5 times its value at the end of 2024, though still far below Apple's market cap. So you could look at that and say Samsung's stock had entered bubble territory. But could you also argue that after decades of being held back by the Korea discount, a $1 trillion valuation was where Samsung should have been all along? Then, by July 30, 2026, Samsung's share price was trading roughly 45% below its June peak. Of course, everybody started freaking out, like, see, it was a bubble and the bubble popped. But do you realize that even after shit hit the fan, Samsung was still worth more than 3 times of what it had been just a year and a half earlier? So, I don't know. Could it be that Samsung had simply gone from being severely undervalued to something closer to fair value and then back to being slightly undervalued again? But then you might push back and say, okay, now I understand that Samsung might have been undervalued rather than simply being a bubble that popped. But if the Korea discount came from long-standing corporate governance problems, what changed? Well, the MSCI classification didn't change, you're right. But during the same period as the AI boom, South Korea underwent a major political and legal shift. President Lee Jae-myung came into power in June 2025 after winning a snap election, and Lee actually campaigned on ending the Korea discount and ushering in a Kospi 5,000 era. When he made that promise, the Kospi was sitting at around 2,500, so he was essentially promising to double the value of the Korean stock market. To that end, the new Korean government began introducing a series of controversial reforms designed to reduce the Korea discount by making Korean companies more attractive to global investors, right in the middle of the global AI boom. If you follow the most viral Western coverage of the Korean stock market crash, you could easily come away thinking that it was South Korea's 14.56 million retail investors, or ANs, who pushed the Kospi into a bubble. I get it because that human element is what gets the clicks and views. But the deeper we got into the timeline, the clearer it became that the AN-driven narrative gets the sequence completely wrong. Here's the thing. The data clearly shows that Korean retail investors did not start this boom. Look, now that you understand the whole Korea discount stuff we just covered, you can see why the Korean government had to do something about it, right? And that meant making the Korean market more attractive not just to local retail investors, but to the big boys. I'm talking about global institutional investors, many of which track MSCI benchmarks and operate under strict investment mandates. So let me walk you through the proper sequence of what happened. On March 31st, 2025, more than 2 months before President Lee even took office and the subsequent market rally began, Korea's Financial Services Commission restored short selling across the entire Korean stock market after a 17-month ban. This was a big deal. For those who don't know, short selling is basically betting that a stock price will fall. When investors short a company, their broker borrows shares from another investor and sells them on their behalf. So if the price falls, they buy back the same number of shares at the lower price, return them to the original owner, and pocket the difference. So if they sell the borrowed shares for $100 and buy them back for $70, they make $30 before fees. Short selling had been temporarily banned in Korea for the previous 17 months after regulators uncovered repeated cases of illegal short selling by major foreign investment banks, basically selling shares without first borrowing them or even confirming that they could be borrowed. Authorities feared that their existing system could not properly detect these illegal trades, so they suspended short selling while they built a new monitoring system and strengthened the penalties. But the ban came with a major cost. For global institutional players like hedge funds, the ability to take short positions is not just about betting against companies. It is a basic tool they use to hedge risk and run sophisticated investment strategies. For many of them, it is a fundamental part of how their business model works. So lifting the short selling ban effectively removed one of the biggest structural barriers that had kept global capital out of the Korean market. That's context number one. How do we know this move was a big deal? Because with the short selling ban lifted and newly inaugurated President Lee Jae-myung signaling that he was serious about reforming Korea's corporate governance system, foreign investors bought more than 1.1 trillion won, or roughly $800 million worth of Korean shares in a single trading session on June 9th, 2025, less than a week into his presidency. By the following day, their total net purchases for the month had already reached around 2.7 billion US dollars. And by the way, this was before any of the proposed reforms had even been passed. Then, beginning in July 2025, the Lee administration launched a series of fundamental reforms, starting with changes to the Commercial Act. Before that, company directors' legal duty was framed as being owed to the company without explicit reference to its shareholders. The problem here was that the interests of the company were often treated as the interests of the controlling chaebol family, meaning that directors could prioritize the family while ordinary shareholders got screwed. But under the new law, directors would now have to act in the interest of both the company and its shareholders. So that was the first reform. In August 2025, another amendment made it easier for minority shareholders at large listed companies to place their own representatives on corporate boards and strengthen the independent oversight of management. By the end of 2025, the government had also introduced lower taxes on dividends from companies that paid more of their profits to shareholders, giving companies a stronger incentive to distribute that money instead of simply hoarding it. Then, in February 2026, lawmakers went after treasury shares, the shares a company buys back and keeps, which chaebol families had sometimes used to strengthen their control without buying more shares themselves. Under the new rules, companies would generally have to cancel those shares within a year instead of holding onto them indefinitely. I just threw a lot of technical stuff at you, but all you need to know is that's like 4 major reform measures in less than a year, all of which were designed to reduce the influence of controlling families over Korean companies and strengthen shareholder protections. In other words, what began as global investors betting that President Lee would reform the Korean market now had actual laws behind it. Suddenly, they had even a stronger reason to believe that owning shares in Korean companies like Samsung might actually be worth more, right in the middle of the global AI boom. So how much of an impact did this series of reforms actually have? Quite a lot. Even by September 16th, just after the second reform, foreign investors had already bought roughly $2 billion worth of Samsung and another $1.85 billion worth of SK Hynix that month. And what were the Korean ants doing? They were selling, not buying. In fact, they were taking almost the exact opposite side of those trades, dumping roughly $3.28 billion worth of Samsung and $1.82 billion worth of SK Hynix. So there goes the narrative that Korean ants were the ones inflating the bubble. But okay, maybe you're still not convinced. So let me just keep giving you the numbers. Because on October 1st, 2025, another dramatic catalyst arrived. Samsung and SK Hynix had just announced partnerships to supply memory chips for OpenAI's massive Stargate data center projects. Suddenly, the market had an easy-to-understand global AI narrative. South Korea's 2 largest companies were being positioned as indispensable suppliers to one of the biggest AI infrastructure build-outs in the world. Unlike the government reforms, which had been unfolding gradually in the background, these were major headline-grabbing announcements that anyone could see and understand. So surely at this point, the Korean ants must have just jumped on the opportunity, right? No. From October 1st through October 22nd, 2025, foreign investors bought a net 5.06 trillion won or $3.54 billion worth of Kospi shares. Meanwhile, Korean retail investors, the ants, sold a net 6.8 trillion won or $4.75 billion. Do you see what happened here? Korean retail investors sold more than foreign investors bought during this period, even as the share prices of Samsung and SK Hynix kept climbing thanks to the additional buying coming from domestic institutional investors, not the ants. So based on these numbers, how can anyone seriously argue that Korean retail investors were the ones inflating the bubble? Very simply, it was institutional investors pouring billions of dollars into Korea's 2 biggest chip makers in the middle of the global AI boom. By October 2025, Samsung's share price had risen more than 80% since the beginning of the year, while SK Hynix had surged around 170%, meaning its value had nearly tripled in less than 10 months. It was mostly foreign capital, okay? Not Korean retail money that drove the repricing or revaluation of South Korea's 2 biggest chip makers. And remember what I said earlier? That President Lee had campaigned on the promise of a Kospi 5,000 back in April 2025 when the index was sitting below 2,500? By the end of October 2025, just 6 months later, the Kospi had already surged more than 4,100, meaning it had reached more than 80% of Lee's ultimate goal. And most importantly, the Korean ants were still not driving the broader rally. Overall, they remained net sellers even as prices continued to climb. So when did the Korean ants finally show up? Beginning in November 2025, only after watching Samsung's share price double and SK Hynix share price more than triple. And almost perfectly, they began rushing in just as foreign investors started heading for the exits. This was the first major handoff from foreign-led repricing to retail-led dip buying and fear of missing out. A second, much larger handoff would come in 2026, ahead of a historic market rout, but more on that later. Here's the irony. Without the ants buying the dip, the market might have fallen much more sharply. By absorbing a large portion of what foreign investors were selling, they initially cushioned the foreign sell-off and helped stabilize the market. Maybe the biggest story here is that retail investors often end up one step behind because sophisticated institutional investors have better research, better tools, and clearer exit strategies. So while ordinary investors are buying near the top, institutions are already locking in their profits, which is exactly what happened during this first handoff. But still, the late 2025 rally became celebrated both politically and socially. Finally, ordinary Koreans struggling with the rising cost of living and limited job opportunities appear to have another way to build wealth besides pouring all their money into real estate. Now, that's a real bubble and probably worth a whole separate explainer along with China's real estate collapse. Anyway, even the Korean government was encouraging people to embrace the stock market. President Lee himself said that he wanted to make stocks, quote, an alternative investment vehicle comparable to real estate, so ordinary people could receive dividends and cover their living expenses. So from the perspective of ordinary Koreans, buying shares in national giants like Samsung and SK Hynix must have felt incredibly safe. After all, these were companies at the center of the global AI boom, so how much could their share prices really fall? But let's face it, it's not like most ants were carefully analyzing whether the two companies' shares were underpriced or overpriced. Most of them probably had no idea about the whole repricing by foreign investors pouring in or heading for the exits. They were buying because their share prices just kept rising and everybody around them seemed to be buying too. But this is where things started getting out of control. In January 2026, just as late arriving retail investors were piling into stocks that had already doubled or tripled, the Lee administration announced yet another market reform, one that many would later argue went too far in retrospect. They announced plans to allow what are called single stock leveraged and inverse ETFs. That sounds complicated, so let me break it down. ETF stands for Exchange Traded Fund. The easiest way to understand a normal ETF is as a ready-made investment package that you can buy and sell on the stock market just like a regular share. That package often contains shares in dozens or even hundreds of different companies, allowing investors to spread out their risk. But a single stock leveraged ETF is designed to magnify the daily movement of just one company, like Samsung or SK Hynix. It's called leveraged because the company managing the ETF uses financial contracts called derivatives, such as swaps and futures, behind the scenes to make your investment behave as though it were twice as large. So if you put in $100, you effectively get $200 worth of exposure to Samsung's daily share price movement. Because of this leverage, if Samsung's share price rises 5% in one day, a 2 times leveraged Samsung ETF aims to give you a return of roughly 10%. But if Samsung falls 5%, the product loses roughly 10%. A 2 times inverse ETF does the opposite. It is essentially a leveraged bet that the company's share price will fall. So if Samsung falls 5%, you make roughly 10%. But if Samsung rises 5%, you lose roughly 10%. You got that? In practice, this meant that ordinary retail investors could take what was effectively a leveraged derivatives position without understanding any of the complicated financial instruments behind it. To them, it felt as simple as buying a normal stock through an app, which was exactly what made it so dangerous. With one push of a button, they could roughly double their percentage gain or double their percentage loss for that day. Speaking of the day, there was another hidden danger. These products were designed to magnify a stock's movement for a single day. So if the stock kept swinging sharply up and down from one trading day to the next, the ETF could steadily lose value even if the stock itself eventually returned close to where it started. In other words, the longer Korean ants held these products in a volatile market, the more money they could lose without fully understanding why. Can you see how this product helped to turn an ant-led rally that was already gaining momentum into something resembling a full-blown bubble? The products didn't actually begin trading until May 27, 2026, but once they did, the response was explosive. In less than 4 weeks, Korean retail investors poured a net 8.2 trillion won, or roughly $5.3 billion into the leveraged versions alone. As retail money poured into these two-time ETFs, the funds themselves had to create more exposure to Samsung and SK Hynix. What that means is, as the stocks rose, they had to buy even more exposure to maintain the promised 2 times leverage, creating a self-reinforcing feedback loop. Higher prices attracted more investors. Their money created more buying pressure, and that pressure pushed prices higher still. So by June 22nd, 2026, the Kospi reached an all-time high of over 9,100, making President Lee's once ambitious target of 5,000 seem like a joke. SK Hynix had surged more than 340% since the beginning of the year and overtook Samsung Electronics as the Kospi's largest common stock by market value for the first time in more than 25 years. Talk about market euphoria. President Lee's reforms appeared to be a historic success, and ordinary Koreans were making unbelievable returns simply by betting that prices would keep rising. But underneath all that excitement, the market had become dangerously concentrated in just 2 companies and increasingly dependent on leveraged retail demand to keep the rally alive. And while everyone in Korea was celebrating, the foreign institutional investors who had originally driven the rally were already heading in the opposite direction. The second handoff was already well on the way. Okay, if you've been paying attention, you might have noticed a major gap in the timeline I just described. The plan to allow single stock leveraged ETFs was announced on January 30th, 2026, but Korean ants couldn't actually start trading on those products until May 27th, nearly 4 months later. So what happened in between? Well, the Kospi just kept rising. It first crossed 5,000 during trading on January 22nd, before crossing 6,000 on February 25th. But it was not a smooth, steady rise. On March 4th, the Kospi plunged more than 12%, falling to 5,094 in the worst one-day closing decline in its history. But the market still came roaring back, crossing 7,000 on May 6th and closing above 8,000 for the first time on May 26th, one day before the leveraged ETFs launched. It then continued climbing until it reached an all-time closing high of 91.15 on June 22nd. So while those ETFs would later turbocharge the market's final and most speculative stage, they clearly did not create the early 2026 rally. The truth is, the ants were absorbing massive amounts of foreign selling and helping keep the market from collapsing sooner, even though they could not prevent the March crash or the much bigger bloodbath that came later. Let me explain. Beginning in January 2026, the foreign investors who had helped drive the massive buying of Samsung and SK Hynix in 2025 suddenly reversed course and began reducing their exposure to the Korean market. In February alone, they net sold $13 billion worth of locally listed Korean stocks. Then in March, their net selling more than doubled to a record $29.6 billion. By the end of May, foreign investors had net sold a combined 114 trillion won, which is roughly $78 billion worth of Korean listed shares since the beginning of the year. During one 12 trading day stretch in May, Samsung and SK Hynix alone accounted for more than 80% of everything foreign investors sold. That's an insane sell-off, and normally, selling on that scale should have crushed the market. But somehow, The Kospi climbed from around 5,000 to more than 8,000 over almost the exact same period. How? Because Korean retail investors and domestic institutions kept stepping up and absorbing enough of what the foreigners were selling to keep the market from collapsing. This was the second handoff. And remember the first handoff we covered in November 2025? That was when foreign investors first began locking in their profits and the Korean ants stepped in to buy the shares they were unloading. The same transfer of ownership and risk was now happening again, but this time on a completely different scale. We're talking about 78 billion US dollars worth of Korean shares moving out of foreign hands. That's an enormous amount for domestic investors to absorb. Upon discovering this piece of information in our research, my immediate next question was, why did foreign institutional investors suddenly begin selling and exiting the Korean stock market from January onward? Because it's strange, right? Some had already locked in enormous profits during the first handoff, but the Kospi was still only around 6,000 when the second handoff began. Had they stayed until the June peak, they could have made way more money. The answer has something to do with how global investment portfolios actually work. Remember how I said many of these funds follow strict investment mandates, and that MSCI still classifies South Korea as an emerging market? Well, at the beginning of 2026, Samsung and SK hynix together made up roughly 8.6% of the MSCI Asia ex-Japan index, which is a major benchmark covering large and mid-sized companies across developed and emerging Asian markets, excluding Japan. Now, imagine a hypothetical fund holding Samsung and SK hynix at their combined benchmark weight of 8.6%. Because their share prices rose so much faster than almost everything else, if that fund had simply held on without selling, the two companies alone would have ballooned to 21.5% of the fund's entire portfolio. According to Reuters, that level of concentration would trigger internal risk limits for many institutional investors and force them to rebalance. So ironically, the better Samsung and SK hynix performed, the more shares some foreign funds had to sell. To me, that sounds like these global funds were simply doing what they're supposed to do, following a clear investment thesis, maintaining diversification, and knowing when to reduce their exposure. And by the way, Korea was not the only market where this was happening. Taiwan had the same concentration problem with TSMC. The AI boom had turned South Korea and Taiwan into Asia's hottest markets, but it had also turned them into extremely concentrated bets on just three chip makers: Samsung, SK hynix, and TSMC. So many global funds began looking elsewhere in Asia for similar exposure to the AI boom without putting such a large portion of their money into only a handful of companies. Increasingly, they were favoring Japan. By late May 2026, foreign investors had pulled nearly $70 billion out of Korean shares. At the same time, Japan had attracted approximately $73.6 billion in foreign inflows by May 22nd. Japan, unlike South Korea, is classified by MSCI as a developed market under its market classification framework. Japan's stock market is also much bigger and more diversified. Its own corporate governance reforms were already attracting global investors, and Japan gave them a way to stay invested in the AI boom while spreading their money across Japanese tech companies, banks, automakers, and industrial giants. Just to put that into perspective, as of early June 2026, the three largest companies in Japan's TOPIX index, Mitsubishi UFJ Financial Group, SoftBank Group, and Toyota, each accounted for only around 3% of the entire index. In other words, Japan offered many of the same attractive investment themes without forcing investors to bet half the market on just two chip makers. The bottom line is, these global funds sent out a clear message when they were already reducing their exposure and diversifying away from Korea. Except almost nobody seemed to hear it. Korean ants saw the continued rise as proof that these stocks could only go higher and kept pouring in more money. So that's how the Kospi kept breaking records until everything fell apart. That brings us to the bloodbath after the market peaked on June 22nd, 2026. And when the Kospi started falling, man, did it fall fast. In just over 5 weeks, the Kospi fell nearly 40% from its June peak. Many ordinary Koreans watched years of savings disappear in a matter of weeks. Some investors had even taken out margin loans, meaning they borrowed money directly from their brokers to buy shares. Margin debt had climbed to a record 38.63 trillion won, or roughly 26.6 billion US dollars. So when prices plunged, brokerages began forcibly selling the shares of investors who could no longer meet their collateral requirements. Those forced sales added even more downward pressure. And that does not even include investors who had piled into 2 times leveraged ETFs. Citi, the global investment bank, estimated that Korean retail investors had suffered around 38.7 billion US dollars in cumulative losses across leveraged ETFs tied to Korean assets. At its lowest point on July 30th, the Kospi's month-to-date decline had temporarily surpassed the record fall of the 1997 Asian financial crisis. For a generation of Koreans, especially those in their 20s and 30s who had come to see the stock market as one of the few legitimate paths to building wealth, the stock market suddenly felt more dangerous than gambling. Things got so bad that the Korean media and the people turned on the government, and Korea's top financial regulators eventually had to publicly apologize for allowing the ETF reform, although by then it was too late. By the way, let me ask you this. Who do you think had already taken the most money off the table while Korean ants were losing money? The same answer we keep coming back to: foreign investors. By the time the Kospi hit rock bottom on July 30th, foreign investors had sold more than 166 trillion won, or roughly 115 billion US dollars worth of Korean shares that year, taking enormous amounts of money off the table and locking in profits on many of their positions along the way. But here's the really crazy part. The very next trading day, the direction suddenly reversed again. Foreign investors bought a record 7.28 trillion won, or roughly 5 billion US dollars worth of shares in a single day, while Korean ants, after absorbing months of foreign selling, dumped a record 8.28 trillion won, or roughly 5.7 billion US dollars. Do you see the pattern here? The ants had bought from foreign investors near the top. Now, after being crushed by the collapse, they were selling those shares back to them near the bottom. At this point, I should make it clear that this is not meant to be a hit piece on global investment funds. I'm just giving you the facts and describing what happened. Like I said, these are extremely smart people doing exactly what they're supposed to do: diversifying risk, planning their exits, and maximizing returns. That is what made it possible for them to sell for months and then immediately start buying again. They had not necessarily changed their entire opinion about the Korean market, Samsung, or SK Hynix. This is why, at the very beginning, I drew a distinction between the true value of a company and its share price. Global institutional investors watched what was happening to those prices and adjusted how much exposure they were willing to accept and at what price. I should also make it clear that foreign investors are not a monolith. This was not Korean investors losing against one unified foreign machine. Some foreign hedge funds also suffered enormous losses and were forced to sell. The real divide here was not nationality. It was leveraged retail investors losing to institutional investors with massive liquidity and far more sophisticated risk management strategies. If anything, it was the Korean government that sought to end the Korea discount, promoting the stock market as a legitimate way for ordinary Koreans to generate wealth, and then arguably went too far by allowing risky products like single stock leveraged ETFs that encouraged increasingly gambling-like behavior. That's the scandal the Korean media has largely focused on. But that focus may also explain why you have heard much less about the main engine behind the entire boom and crash. Global funds first poured money into Korea, then reduced their exposure according to their investment mandates, while Korean individuals were left absorbing much of the risk. Maybe the ultimate lesson here begins with acknowledging that there is clearly massive anxiety about a potential global AI bubble right now, and everyone is nervous because no one knows when or how this is going to pop. Maybe that is why people keep looking to markets like Korea and Japan, hoping to find some kind of preview of what might happen elsewhere. I get it. But as a viewer, you should not buy into simplified headlines and narratives that either deliberately or accidentally leaves out the forces that actually drove and intensified the Korean stock market crash. For me, the takeaway is that the Korean stock market is far from dead, and there are still enormous opportunities to invest in undervalued Korean and other Asian companies. One reason is that even after the massive second handoff, foreign investors still owned around 40% of the Kospi in early August 2026, which is even a larger share than they held at the beginning of the year. Think about that. They sold more Korean stock in 7 months than in any year on record, and they still ended up owning more of Korea than when they started. To be fair, part of that increase came from their remaining Samsung and SK Hynix holdings outperforming the rest of the market. But the broader point remains that they did not abandon Korea, and the direction of the Korean market will continue to be heavily influenced by the global capital. So if Korea's corporate governance reforms continue, the next phase of the repricing may not be limited to Samsung and SK Hynix. It could gradually spread to other undervalued Korean companies that have spent decades trapped under the Korea discount. At the same time, it's entirely possible that the reforms went too far because they eventually handed ordinary Koreans a 2 times leveraged bet on a volatile stock market. So was that the price of finally killing the Korea discount? Or was it just an honest mistake that Korea will learn from? But here is what I'll repeat from what I said in our previous video on Japan's national debt, which you should really watch after this one. What happened in Korea is so specific to Korea, politically and culturally, that I'm just not convinced that you can hold it up as a preview of what's coming for the American stock market. If there's one thing worth taking from all of this, maybe it's that the story was never really about the ants. So the next time someone tells you the market crashed because ordinary people got greedy, ask who was on the other side of those trades and when they got out. If you found this video insightful and feel better informed as a result, make sure to subscribe to Asian Boss, hit that notification bell, and share this video with your family and friends. Our mission is to be your authentic go-to source for all Asia-related insights for the global English-speaking audience, especially for business, tech, and culture. But to be honest, it's really hard to cut through the noise as well as the algorithm. This is especially true when we cover topics like the Korean stock market or Japan's national debt. Why do I say that? Because it doesn't matter how much we try to give you the full picture and deliver nuanced perspectives. It'll just get buried by more clickbait videos that paint doomer narratives about Korea and Japan. It used to be mainstream media, but increasingly more Western content creators are doing this as well, relying on the headlines and just cherry-picking whatever they think will be the most viral angle. This reminds me of why I started Asian Boss. It goes back to when the whole world was freaking out about the North Korean missile threats, and everyone was acting like South Koreans must be super scared, when that was not true at all. No South Korean citizens were panicking. We just wanted to show what's really happening in Asia from Asia. At this point, we're not that small of a channel, obviously, but we still have a long way to go to establishing ourselves as the authoritative source. So we have to get bigger. So we'll continue to do our part, bringing you the most in-depth, honest reporting straight from the ground. But you can also play a part to help inform the global audience. If you're watching this from Asia and you happen to be a fan of our mission, participate in our future live stream sessions, where you can contribute your local insight and let me ask you questions to fact check our research. You can do that by filling out the form in the description, submitting a short video intro, and telling us what kind of insights you can share from your country with our global audience. I'll personally review your submission and get in touch if we can invite you to join a future live stream session. Think of it as letting our audience see how we conduct a street interview in real time with no edits. We can even brainstorm future topics together. This is how serious we are about building a truly authentic media platform that can challenge mainstream media, and I hope you'll be a part of it. Of course, I'm Stephen Park. Thanks for watching all the way to the end, and as always, stay curious.